Righto, g'day, money warders. Today, what do we got today, boys, mate? Bit of bloody Capricorn, bit of Boss, bit of Yancoal, bit of random shit. Bloody, it's all go in Money of Mine HQ.
We got in some weeds asking some interesting questions that just pop up every now and again. I feel like sometimes our job is just exploring questions that come into our...
Exploring questions that haven't even been asked.
Yeah,
maybe.
Are we the first people to ask the questions?
I think we are. Bloody as simple as that. JD, how are you in the East Coast, Cobber?
I'm doing well. I'm excited to rip into these ones. We've got a bit of a random one later on, chatting about anything sort of piquing our interest, and there's plenty of things going on at the moment. So keen to get into it, fellas.
Oh, mate, and stay tuned. Mate, we've got a rip snorter amount of interviews this week. We did a big uranium one yesterday with a London analyst, and, mate, we've got a couple more coming this week. But diversity for the money miners.
Yeah, we probably won't release them all this week, but we've been busy.
They're in the pipeline. Right, now the VRIFY drinks. We had them the other week at Mayfair. Bloody a few punters rocked up for a schooner and a couple of VRIFY demos. But the question I asked is, all these people coming to scab a free beer, I want to know if they've taken action and done the right thing and signed up to VRIFY. We may have just called one of them and said that he hadn't taken action yet, and this company is now on my radar in a bad way.
Yeah, mate, that was a funny phone call that we had. We thought it'd be good content for
the ad.
We thought
it'd be good, but they're like,
we interrupted someone mid-washing up the dishes.
and
that's one way to turn down a free bonus. Not sure why, but
isn't that the truth, JD? God, obviously washing up was more important than highlighting your ore body in a 3D way to all the investors. But look, anyway, we can only lead the horse to the water. We can't make them bloody drink.
Yeah, well,
free money's not for everyone.
Oh.
Unverified. That's it. Hashtag unverified, mate. Check your bloody company. See if they are using VRIFY. If they're not, bloody contact the internal relations email and just say, why are you unverified?
Why put a big bloody 3D ore body mineral resource out in a 2D form? Like, I just cannot bloody fathom it. I don't get the picture. And as we said, it's usually because they're bloody hiding something, I reckon. So just do the right thing. Communicate in 3D. Mate, the drill holes, the geophys. Show what the underground or open pit mine looks like. It's not just for explorers, mate. Could be pre-resource exploration, resource stage, development or production. Bloody just take action. It does.
Mate, Capstone Copper yesterday got four bloody mining operations, and they've got it. There's no excuses.
There you go. And I think why they're not trading, I don't know, because they've got VRIFY. Like, it's as simple as that. Why there isn't
probably
a trade.
Too much liquidity over in Canada
because of the VRIFY, and there's just nothing left to go ththrough the books in Australia.
Exactly.
I think you're bang on the money there, JD. So, mate, don't be scared of if you got bloody shitloads of data and you don't know what to do with it. VRIFY convert it for you into a cutting edge 3D model, Trav.
Yeah,
don't they just?
They do, mate. If I were to speak with any, junior mining CEO and I asked, why do you not have your ore body in VRIFY? My assumption is you are hiding something.
Exactly. Don't put your company at risk by having the investment community just not understand what the fuck you actually have. That's just...
You're probably doing that because it's a turd.
Yeah, exactly. Get VRIFY and there'll be no questions left unanswered. Simple as that. Email grant@verify.com. No E. Right. Devil in the detail, boys. First story of the day, Capricorn's record numbers. How can there be any devil in the detail with Capricorn, the market darling of the gold sector? You'd say,
sure are,
Jonas
mate.
Benedict. Mate, take it away.
Yeah.
Read right into it for me.
Yeah, record numbers with a bit of an asterisk, which we'll get into. So they had their best half-year profit numbers to date. And now this is largely on the back of the higher realised prices. So revenue was up 30% comparing it to the previous corresponding period. But this is all a result of what they did with their hedges in June of 2023. So we'll get into that in a bit. But covering more of the details for the half year, they milled slightly less. The recoveries were down, but they had better grades at about 1 gram per tonne. So not stellar, but these guys know how to run that profitably, as we've touched on in the past. Costs, all-in sustaining cost was up almost 20% to Aussie $13.20 per ounce. So that means they're tracking right on for their guidance midpoints of 120,000 ounces at $13.20 all-in sustaining cost. And in terms of cash build, they built $50 million for the half, cash and bullion of $160, with debt of $50. That's due on a bullet payment in mid-2025. They've got net cash of $110.
Imagine if that pit was 1.5 grams instead of less than 1. Amazing how much what they're doing with a bloody sub 1 gram ore body or 1 on the dot. Pretty unbelievable.
Absolutely. But it would have had a bit more attention. That's why they were the ones that went in and swooped it up when they did.
So, JD, the hedges. What is going on with the hedges? There's a bit of some different mechanisms here than we talked talked about it last year.
We talked about it with the Romano Salatena as well.
Yeah.
In our recent conversation.
Yeah, when they effectively closed out the hedge for a year and a bit. So, what's going on?
Yeah, so the hedge book is pretty interesting here. So, like I said, they had really good revenues this year because of the realized gold price. So they realized over $3,000 an ounce for the half year. Now they only achieved this by closing out hedges of 51,000 ounces back in June, right around when we were getting started with money in mind. So essentially what they did is they realized a big expense back then, and it means they can report all these, record cash flow numbers today. And it also meant that they wouldn't have any hedges up until September of this year. But from then on, for, a period, they put it between 1 and 5 years. We don't get it broken out of when it's due. They've got 107,000 ounces of hedges still due at $2,330 roughly. Plus, they've sold call options on 16,700 ounces, 1,000 ounces rather, at Aussie 2,260. So you can essentially think of those as hedges as well, which means the hedges now sit on other financial liabilities on the balance sheet, given there was a bit of a tweaking in how they account for these things. So they sit as a liability of $106 million currently. And if you look through all the analysts, they sort of put this at a bit under $100 million liability when they work out the values of these businesses. And that amount, that $106 million, that's going to fluctuate because it's marked to market as the gold price moves between now and until they start delivering into it over, the next financial year 25, and then financial year 26.
It's interesting, Capricorn, right? Because, we know that this management team, while they were at the helm of Regis, and I think even before that, they had a tendency to basically roll near-term hedges. And they would basically roll to the back end, and then it would kind of maximize near-term cash flow, but you would lock in, essentially a lower real gold price in the future, which can come back to bite you in the way that happened to Regis, and we've sort of seen some of that rolling activity in the past. What are your thoughts around how management is treating their hedge book at this company, JD?
Yeah, I think it's an interesting way to put it, mate. Another way to think about it is that these hedges were set up when they were getting into production. Now, they started in 2020 producing, and to have hedges that were set up when the mine was coming online, still in effect by, maybe 2026, is a fairly long time if you haven't signed up new hedges. So that's sort of one way to think about it. So I guess what we're kind of alluding to is that they're pushing this liability down the road to realize better prices in the near term. And, perhaps it's working. They're working on getting Mount Gibson online, and depending on whether they sign up more debt and whether they have to enter into new hedges, if they don't do that, the amount of hedges they'll be hedging will be relatively smaller, given a substantial amount of more ounces will be sort of coming online and being produced. So that percentage of production hedged will be relatively small. But essentially, like you're sort of alluding there to, Trav, they are pushing it down the road because they don't want to realize it now, and they want to experience those greater cash flows with gold as it is, but it doesn't go away.
I think I saw in one note they're anticipating to fund Mount Gibson all from Karlawinda cash flows, aren't they? They're not looking to get more debt.
They have a non-binding term sheet with Macquarie for $200 million if needed. So I think they'd very much like to be able to fund it from the net cash that they have, plus the cash flows that they will produce between now and when they really need to start ramping up on building the thing there. And I mean, a bit more detail on Mount Gibson. There was a bit of colour given in the half year today. They've got 400 accommodation units starting to arrive, so things are really starting to happen. That's going to cost $30 million over the calendar year. They announced in December an MRE of 3.2 million ounces, and would expect in the 6-month period we're in now until halfway through this year, an update on the reserve, which currently sits at just under 1.5 million ounces. One of the key things to look out for is the environmental permitting, though. So they'll get an update which will dictate the pathway, whether it's a state or a federal pathway that they have to go down. And that's quite an important one, which could act as a bit of a catalyst. But we're still expecting first gold in the December quarter of 2025, although that is getting pretty close now. So I do note that some of the analysts out there have sort of said that they're being cautious and conservative and anticipating that 6 months later.
So, JD, in addition to closing out those hedges, the 51,000 ounces last year, they also bought put options as well. So that were they around $2,800 an ounce. So that was, again, like a bit of a premium they're paying to protect themselves from any downside to the gold price, yeah?
Yeah, that's the way to think about it, Matty. They were in line with the corresponding periods of the hedges, so 13,000, 13,000, 13,000 over each of the quarters, and a 12,000 in line with what those hedges would have been as a bit of protection. But there was a circa $36 million charge that they realised back in June to close out that hedge at the time to realise the cash flows that they're realising now.
Are those put options only in place during this unhedged period before the hedges kick in?
Those put options expire by sort of mid this year.
Yeah, which is when the hedging kicks back in. Yeah.
That's right. Hedging kicks back in from the September period.
Mate, you can tell an accountant, but he runs this company. You're looking at a balance sheet there with, bought put options, sold call options, and then all of the derivative hedging dynamics, which go out over 5 years. So it's just you can tell there's some financial bloody manoeuvring.
But I think that hedging going forward until it's closed out, I think is 29% of production at 2,300 or so. So it's
is that just the hedge book, or are you including the sold call options as well, which is another 16,000 ounces?
Just the hedge book over that period till they're done.
And that's obviously making an assumption on when they deliver into those hedges.
Yeah.
So in terms of trading multiples, we've spoken about Capricorn a bunch of times, trading at a premium, a sort of management premium that they get for their ability to execute and deliver decent cash flows. And that's pretty well reflected on next 12 months EBITDA. It's 8.8 times. So I'll chuck up a little chart here, and you can see that only puts them behind Emerald in terms of the peers I've sort of plucked out there. And on a NAV basis, we're talking about 0.86 times. And that puts them relatively middle of the pack. I'd say that Capricorn is pretty well priced for Mount Gibson to come online smoothly and start adding to cash flow to the bottom line.
Very interesting, mate. Yeah, you've got one project in production, another one which is undeveloped. So you'd want to present that NAV on a risk basis probably, but 0.886 times is interesting.
Righto, Yancoal. Jesus Christ, isn't this a big bloody course of sale? $200 million and 65 cents. Mate, crossing this morning. Trav, you're a bloody Yancoal holder, aren't you?
Ding, ding, ding. Yeah, full disclosure.
Right, what's going on here?
Yeah, JD, do you want to start with this one, and I'll take it from there?
That wasn't you.
Yeah,
on that cross, was it, Trav?
I was just flicking through everything going on, this morning, and there was a Street Talk article out last night as well on the matter with a bit more detail. But $200 million crossed in stock, about 2.7% of the company. So the deal was done at $5.69 per share, which is just a marginal discount to the last close. And the seller, which I'm sure you'll get into, Trav, was also known as Cinder China, a entity, I believe, registered in Hong Kong. So they were over 12% holders and now are sitting just under 10%.
Yeah, mate. And this is the thing I want to go into is why is this a big deal for Yancoal, right? You got your second largest shareholder selling down, a bit less than 3%. Why am I kind of interested in this? It's And I'll try and articulate it in a succinct way, talking about index eligibility, free float, and also some Chinese asset management companies along the way. But by market capitalization, if you were just to rank all of the ASX listed companies and rank them by market cap, Yancoal is the 74th largest stock on the ASX, and yet it is not included in the ASX 100 index, the ASX 200 index, or even the ASX 300 index. And you might be wondering, how does that even make sense?
Is it to do with China?
It's not explicitly a geopolitical thing here, but it's the fact that they've got a big shareholder is part of it. To be included in the indexes, the eligibility criteria is not as simple as just ranking by market cap. To be specific, to be eligible for inclusion, the securities are ranked by float adjusted market capitalization, and they need to be highly liquid. So this sell down by Cinder is a relatively big deal because it improves both of the above for Yancoal. On the first point, float adjusted market cap. What does that even mean, right? If you think about the market cap of a company, not all the shares outstanding are actually available to the market. What the indices do is aim to adjust for the fact that different companies have different free floats, so that the marginal price swings from the ETFs is really in line with each other. Take Yancoal, for example. Their market cap is $7.4 billion, massive, right? But 62% of the shares outstanding are owned by Shandong Energy, and now just less than 10% is owned by Cinder. So the float adjusting would effectively remove those holdings from the calculation because they're considered long-term strategic shareholders whose holdings are not available to the market. So in aggregate, 27% of the shares are free float in quotation marks. S&P would therefore apply a factor of 0.27 and multiply that by the market cap and get approximately a $2 billion float adjusted market cap.
Yeah, so why? So I assume they adjust these for the free float to take into account, like, even though they're a massive company, it's not liquid enough to be in those indexes. Is that how it works?
Well, if you think about why do you float adjust it? Interestingly, this wasn't always the case for what the indices would do. And I think if any of the money miners out there have listened to some of the work from Mike Green, he talks about historically how you'd have these effects where in the .com bubble, right, the indices would adjust based on market cap, and what happened was the tech companies who had a massive amount of their issued shares still owned by the founder. Therefore, they had a lower free float, but they were still weighted by market cap. And the
VCs that would have owned it, yeah.
Because there's less supply of the shares actually available to the market in some sense. When the ETFs come buying and selling, they're buying in proportion to the market cap, but they're having an outsized influence on the price because there's more flows relative to what shares are actually traded and actually available. So, I kind of think of it as, imagine if you're blowing up a balloon, but you're squeezing down half of that balloon already. It's going to bloody, get to a point where it's going to bust a lot sooner. And so you accentuate the movements to the upside and the downside from what the ETFs are actually doing if you're not accounting for the free float.
Has that always been the case in Australia? I
don't know the history too well in Australia, but it's what the indices have done for a long time.
Yeah, right. But is that still the case in America? Do you know?
Yeah. This is standard for all indices and ETFs now. Is float adjusting the market cap. There might be some niche indices where it isn't the case, but yeah, that is pretty standard for your big indices.
Yeah, mate. Money miners out there, let us know when that come in. We're all ears. Save us Googling it.
So in Yancoal's case, their float adjusted market cap is approximately $2 billion post sell down from Cinder. And on my napkin maths, that would rank them in the top 200 companies on the ASX. But it's not as simple as Yancoal being in the top 200 free float adjusted market caps before it will go into the ASX 300 and the ASX 200. There's also this relative liquidity requirement. Relative liquidity is a funky metric that looks to quantify a stock's liquidity measured relative to its peers. I'm going to flash up the formula for the YouTube viewers if you want the arithmetic in front of you. The important thing to know is that Yancoal's relative liquidity before the sell down from Cinder, was certainly below 30%, and the number needs to be above 30% to be included in the ASX 300, and it needs to be above 50% to be included in the ASX 200. So why does the Cinder sell down help? It's because, the increase in free float means more shares are now in the hands of active ASX market participants, which equals more liquidity. And it's still yet to be seen whether Yancoal's relative liquidity is going to exceed the 30% number, which is required for inclusion in the ASX 300. And on my rough numbers, I think it still comes up shy. But the question that's worth digging into is, will Cinder sell down even more? Because if you have more sell downs from either of the two major shareholders there, then that might actually be what can be a catalyst for having enough float, enough liquidity to be eligible for these indices. So I took a look into Cinder, and to me, I kind of get the impression that maybe this sell down by Cinder was to firm up their balance sheet. Earlier this year, the credit rating agency Fitch downgraded Cinder's credit rating from A to A-. On the 31st of January, Fitch put out another note articulating that China's national asset management companies, of which Cinder is one of them, they're receiving reduced government support. And check out this quote. The lack of direct sizable capital injections from the Chinese government, despite the considerable capital pressure faced by some of these, highlights the inconsistent and less timely extraordinary support that they have received from state shareholders. So it's relatively easy to paint a narrative that Cinder may be able to sell down further, which would enhance Yancoal's relative liquidity and eligibility for index inclusion. But I think it's important to also, note that it's not all rosy and optimistic for Yancoal, because I listened to their earnings call, which was actually yesterday morning, and I was disappointed in some of the commentary around distributions to shareholders. Yancoal announced a dividend that was definitely on the lower end of what market expectations were, and disappointingly, the commentary around potential for any special dividend was very muted. And in the Q&A, management played up the potential of accretive M&A, the scope of which seemed pretty unconstrained too by the response. It could include met coal, renewables, other minerals. It didn't constrain geographically either. It could be Australia or internationally. The only constraint was that some countries are easier to get foreign investment approval than others. So when I think about the biggest risk with Yancoal, I actually think it's dumb M&A favoured over shareholder distributions.
Speaking of questionable M&A, MinRes and Bald Hill. Tax claim come out yesterday. What's going on here, JD?
This one was bloody hard to actually get your hands on. It was lodged with the Singapore Exchange, but there was an article in the West headlined, MinRes could guarantee $203 million tax claim on Bald Hill, while assessments reviewed say liquidators. So MinRes proposes paying $63 million while guaranteeing the rest of that $200 million claim. And while everything's pretty info light here and the final amount isn't yet determined, I think it's fair to say that the ATO want what they call their money back. So that $200 million figure, to be clear, relates to taxes payable by Alita over a number of the financial years since they went under in 2019. Now, there's also this Supreme Court case ongoing in the background. That's by some of the former Alita directors trying to, get things back to how they used to be and essentially fighting the MinRes buying Bald Hill claim. But I'm sure MinRes can continue to fight that one off. So I think the interesting, and perhaps open-ended questions to think about here are, what would a guarantee look like, and would it put any restrictions on cash? We know MinRes is in a period where they're really trying to shore up the balance sheet and convince analysts that there's nothing to worry about on that front. But you've also got Chris Ellison seeming like he's pretty eager, given the sell down in Azure, to pursue an opportunity. Plenty of rumours swirling around what that opportunity might be, but perhaps a guarantee hampers any plans he's got there. I'm not sure if you guys had thoughts reading through this one.
Yeah, I think who knows what he's up to. It has to be pretty. You'd think it'd be somewhat reactive to the current lithium price environment, whether pursuing the same thesis until prices rebound. It's a pretty bloody high risk. Hoping for a big bloody turnaround, because it doesn't turn around till it does.
Yeah, he hasn't. They've made a lot of the bonds out being covenant light, but I don't think restrictions on cash would be, something he favors too much, especially if he wants to go and buy something, then you couldn't just go and spend the cash. So we'll see what it exactly means, and I'm sure this is just something that's going to drag on and on in the background.
Hey, maybe he'll get into gold. There's still a possibility. Oh, bloody mate, what better bloody hedge there? Oh, we'll see. Right, JD, Boss, they completed the purchase of 30% of Alta Mesa, the in-situ recovery project in South Texas.
They did, mate. So 30%, they picked that up. We spoke about it a couple months back. It was interesting reading through some of the comments by Duncan Crabb, the boss there, on Honeymoon. He said it's on track and first drums of uranium to be produced in the coming weeks. So that stockpile that they bought a couple years back now is worth 195 million. For those that forgot, that's 1.25 million pounds of uranium they've just got sitting in a shed somewhere. So that's gone pretty well. That was based on US $102 per pound, so we're slightly below that now. But
they've also got cash of. I think I read the note. Their pro forma cash after this deal was anticipated to be $176 million with no debt. In addition to this, whatever it's valued today, $180 million worth of inventories as well. So bloody sitting.
Mate, it's not something you see every day for a company. A couple of weeks from first production on a single asset, essentially.
Oh, it helps when they raised $200 last year.
Yeah.
Yeah.
The big question is just going to be what working capital is required to get to positive cash flow at that asset as well.
Absolutely. And it's, of note that 200 odd raising didn't go all toward this acquisition. Only US 60 was for the stake in the project, plus a small wedge going to a stake in the actual parent company, Encore, who will be the managers of the JV there.
And of course, some exploration spend, mate, not working capital for ramp up.
No, you could never call it working capital, mate.
Although they might have had some working capital in there, but yeah, a lot of exploration.
Yeah, well, that Alta Mesa, so that's a 70-30 JV between Encore and Boss. So Encore have got a lot of in situ recovery projects and development projects in and around. I think it's like there's Texas, Wyoming, that whole area in America. So they'll manage the JV, but because they actually bought that project off Energy Fuels in November 2022 for US 120 million, and now they've sold 30% for 60 million. So up a bit. 60 million of that 120 was in a convertible note, but it sounded like it's something that Encore needed to do something quickly because they only had US 2.7 million in the bank at the back end of Q3 last year. So it was either, and they'd already raised 170 million bucks worth of equity in the previous 12 months. So I don't think another capital raise would have been good for them. So they was sort of took away a lot of equity overhang, this deal with Boss. So, but it's interesting looking at the grade. It's compared to like Honeymoon and everything. It's like the resources they put it as percents, so it sits at a bit above 0.1%. So that's 1,200 parts per million for the total resource. The Boss's Honeymoon project is only 620, so it's a lot higher grade. But the total resource size is about a quarter the size of their Honeymoon project. So I think Honeymoon's 71 million pounds total resource, so a bit of that's including the inferred, and Alta Mesa is 16 million pounds. But the Boss funds that have gone to Encore, they've said are going towards further exploration at that Alta Mesa to hopefully expand that project. So I found it interesting when I don't know if it's sneaky or there's a reason for it, but you look at the resource tables, you look at the Honeymoon side, it's in million pounds, 71.6, but then you go over to the Alta Mesa side, it's in 1,000 pounds. So it looked like that was bigger until you look at the bloody thing. So just keep it bloody consistent. Why can't it be the same?
You got to make the numbers look
Maybe
good,
it's a NI 43 requirement. I'm not sure.
All the companies in the annual report, some are millions, some are thousands.
And then you got they're right next to each other. So because Boss, they'll earn a further 9% return. So they've actually lent loaned £200,000, which I assume is coming from that inventory pile they've got, to Encore. So, because Encore's Rosita project is ramping up, so and they've got some near to contracts to fulfill there. So I think that £200,000 is de-risking that for Encore. So, yeah, building scale, JD. Another bit of a play here by a couple of uranium punters.
Mate, it's all part of the classic uranium playbook. Just build scale as much as you can, and then you get that flow of funds, and you get the ETFs interested.
Just money flowing.
Yeah,
just
and then
everywhere.
it's self-perpetuating whilst things go up until a point.
Yeah. It'll be interesting to see what relationship Boss and Encore will have going for, because if you put them together, so Encore, they have potentially £5.5 million of output coming from 2027. Then Boss's Honeymoon, they aim to put out £2.45 million from 26 onwards. And then look at how much cash Boss has at the moment. They only have 5.5% of their total volume out of Honeymoon to 2030 committed to contracts. So they're fully exposed to the spot price. So the Canaccord note has them sitting at $500 million in cash by the end of FY26. So it'd be interesting to see if there's any further deals or M&A done between Boss and Encore to leverage the scale and combine all these in situ recovery projects. That'll get those flows happening, those ETF and index flows, JD, we talk about. Or will Boss deploy the cash elsewhere? So very interesting to see.
Yeah, they'll be hoping they get through the next few weeks and months smoothly, like you point out, Trav, making sure there's not too much a dip in the working capital. We get into that uranium interview, which we're going to share soon, the returns and how that all happens for an ISR project. But fingers crossed for them that everything goes smoothly.
Right, with that old Mr. Sandeep Biswas has popped back up. Elliott Management. What's going on here?
Mate, Sandeep is the familiar name to you, but Elliott is the name that JD would be frothing over.
Absolutely. So I've just whipped together a bunch of random things that sort of stood out to me, and there's a bunch of things going on around, whether that's investing or mining specifically or commodity prices and whatnot. And I thought it was worth talking about. So first and foremost, like you mentioned there, Maddie, Sandeep Biswas is going to run a unit from Elliott Management. They're a very famous US investor set up in the 70s, and they're going to get about US $1 billion to invest in mining assets. So that's, a small slice of the 65 odd billion that Elliott manages. The info is pretty light on, but they're looking at base metals and precious metals, single mines, buyouts, buying stakes in miners. So, they're essentially looking at everything you could look. For people wondering who Elliott is and a bit more about them, the thing that comes to mind for me, their most famous interaction was they picked up these sovereign bonds from none other than Argentina, and it led to a court case that I think went on for 15 odd years, and they eventually won. I think they got a $2.4 billion payout for their troubles and for that ongoing battle, and that leads to them having a less than impressive reputation in Argentina amongst the general population there.
That'd be, isn't that funny? Obviously, I didn't mention it. Sandeep Biswas, the former Newcrest mining CEO, which is obviously now Newmont. But throw this into the mix in addition to your YALs and your Gina Reinhardt's, a lot of capital coming into mining. This could heat up. Mate, the Greatland Gold bloody punters will be frothing over this. Wait till the rumours start swirling.
Elliott, they've had a few activist campaigns. I remember when we interviewed Peter Kerr, and he told us the story of the Make BHP Great Again. That was Tribeca piggybacking on an activist campaign that
right?
Elliott were putting on BHP at the time.
Yeah, right.
Yeah.
Yeah, they are, they're not afraid to throw their weight around.
Yeah.
Right.
Another bit that...
What else we got, JD, in your bucket of goodies at the end here?
Pantoro, so they've been tracking along. We've obviously spoken about them quite a bit, but I saw Regal, the fund manager, lift their interest from 9.5 to 10.5%. I'm not sure if you guys had further thoughts on this one, but it's interesting just to put it in perspective with the troubles that we've seen and the consensus being, less than flattering of the company Pantoro recently, that the guys would up their stake. There could always be much more that meets the eye than first reading these things. But
I took a look. Yeah, I took a look at the annexure of trades there, JD, just to sort of see, because the question is, Regal trying to pick a turnaround here, but I don't think I'm convinced of that, because I look at how much of we know you have to lob a change of substantial when you change your interest by more than 1% if you're already a substantial shareholder, and only 150 grand is there buying in this calendar year. So it's not like they've been really aggressive on the screen this calendar year. They've just been sort of every couple of weeks picking up a little bit ever since their last update, which was in October.
Is Regal's position there? That was from before the merger, wasn't it?
They were shareholders in both Tulla and Pantoro beforehand, and then they probably also contributed to the capital raising that was undertaken at the time of the merger as well.
Right, JD, nickel mining profitability. Jeez.
Yeah, well,
is that a sentence?
Not so profitable, I guess, is the takeaway. There was a report that came out from Macquarie, and they said, they put some sort of numbers to it. They said 7% of global supply has already been switched off in recent times. They said at US $18,000 per tonne that 35% of the mines out there would be unprofitable, and at $15,000, 75% of mines would be unprofitable. So given we're floating at about US $17,000 a tonne at the moment, gives you a rough indication. And putting that into a broader perspective, you can see that a lot of the Western operations are the ones switching off in recent times. And, it was no secret that Indonesia's proportion of global supply was on the rise, but that's only going to accelerate with all these other operations turning off. And they're going to be an enormous part of, the global nickel supply. Obviously, that's no secret.
Right, just keep a rolling, JD. Roll
Alrighty.
on, brother. You're on fire.
I'm not sure if you guys have ever tracked the Bloomberg Commodities Index. It's a bit of a basket. It's made up of...
Every morning I have a look, mate. Yep.
Is it?
Well, I know
isn't the Goldman Sachs one is the one that everyone uses? They always bloody track S&P divided by the Goldman Sachs Commodity Index, and it's like
people love that ratio, and it's it's a lot more than meets the eye on that one. But this one is a basket of commodities, so not just your metals and mining. 30% energy, 20% grains, 15% industrial metals, 18% precious metals. But if I pull up the chart here for the last couple of years, it looks pretty grim. It is down to levels seen in December 21. But, to put things into perspective again, on a 5-year view, things aren't too bad. It's been a rough time. And that last couple year period obviously coincides with inflation spiking up and then trailing off, as we've seen. But something interesting that just sort of stood out to me. Keeping it hot, I saw Azur's short interest creeping up. We obviously touched on what could be going on. MinRes selling down their stake. It's relatively small, 0.75% of the company. So perhaps not anything to really read into, but it was a pretty sharp jump up in the last week or so. It's a bit over $10 million worth. And in terms of other short positions out there, we spoke about that interesting trading activity in 29 Metals. And it turns out what we kind of guessed was right. There was a closing out of short positions. Short net fell from 4% to 2% of shares. And whilst we're on the reoccurring theme of MinRes, their short interest has been steadily climbing, now over 5% of the company, obviously on a much larger scale than both 29 Metals and Azure, that 5%, being worth circa $500 million.
I think I read
29 Metals ripped again yesterday too.
Yeah, they did too.
Yeah, like 20% or something.
On the MinRes short interest, so I was reading comments in the AFR, must have been on the weekend, but it was from Dion Hershen at Yarra Capital Management, sort of saying that all of the iron ore producers are trading as if their earnings are not kind of fragile in this elevated environment, but they're anticipating an up to 50% bloody correction in iron ore prices.
Yeah, it was pretty punchy.
Yeah,
very punchy.
Yeah, there was a little write up that was accompanied with that by the guys at Yarra, and that's got serious ramifications for the ASX 200 and the Aussie market.
But that was in relation to Simandou coming online long term, wasn't it? I think a lot of that was around.
Yeah, and I
Still
think
bloody ages away.
the thesis was tied in with supply coming not just from Samandu, but that was the biggest one.
Right, what else you got, JD? You're on fire today, mate. Just
A couple more
park
to
up and
rattle
watch
off.
the show.
Mate, the lithium spod price that I look at, SpodCon 6% equivalent, ticked up for the first time in months, which will be very refreshing news to a lot of people across Australia. So from a low base, 850 to 870.
Oh,
but
look out. I wonder how much it was traded, how much of a quantity it was.
yeah, maybe one contract, who knows?
Yeah, I'd say so.
And lastly, on the theme that we touched on regarding Coronado last week, there's this notion that India is going to be the growth project, and a lot of people have been buying into that. They're the ones that are going to gobble up commodities over the coming decades, similar to what China has done over the past. And there was a chart put up by Stanmore that stood out to me. So they really furthered this. The numbers come from WoodMac, and it sort of grows the interest coming from India as well as Southeast Asia in terms of ultimate steel production. So if you compare last year's production to 2050 expectations, you got China down 22%, India up 220%, and Southeast Asia up 177%. So obviously Stanmore putting this chart in their presentation speaks to something that they would very much like to see eventuate, but interesting nevertheless, given that the numbers come from a quote-unquote independent commodity price forecaster.
Good work, Benedict. Bloody legend, mate.
Gracias, mate.
Hope you're enjoying all those bloody lattes in Melbourne, mate. We miss you all the time. Right. Thanks to all the bloody partners as always. VRIFY, InvestorHub, DSI Underground, SMEC Parent Technology, McMahon Mining Title Services, Anytime Exploration Services, KCA Site Services, Brooks Airways,
And K-Drill. Hooroo, money miners.
Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.